Hey, what's going on, everybody? How y'all doing? I'll get a sound check. I approaching this with the system adjusted a little bit. I just need to know that everything is good. Y'all hear me now? All right, I got audio on YouTube, so I'm going that you guys can hear me as well. Everything looks good. All right, all right. So, um, that's a good question. I don't know why our restream doesn't run in 1080 DPI. I don't get to choose that. I'm not the one that paid for our restream either, so it's very likely because of that. Maybe if the Bullish Bears upgraded the restream to a pro version in 1080p. Maybe. But I don't choose. I just read it. If I want full high definition quality, we would need to upgrade to a higher restream level. That's why. So there you go. We don't have a high enough restream. Yeah. There's some anxiety going on about Colombia's debt market. This just really hit. I'm was kind of getting into it right when the time for me to stream was coming in. So I just barely found out about it. JP Morgan, Citibank, a couple other big institutions, 14 major market makers have reached out about this issue with Colombia's debt market. Japan was the one or is the one that we're all really concerned about. Now we've got to worry about Colombia and Venezuela, right? Because don't forget, we got that issue riding on the table. When it comes to global equity markets, it's only going to take one thing, to topple the house of cards. And most of the time, everything's fine, most of the time. If we do get some sort of flash crash event, just buy the dip, yo. That's what I'm going to do. You can go back to January 2020 and look at the rally out of March. It took 3 months, so you might have to hold on for a little while, but no matter how bad it gets out there, the faster we fall, the more likely it is we come back again. Yeah, and add time. That's a really good thing to, yes, add time for reallys. So what we got on the screen right here is the CME. If you are not watching my morning briefings, then you didn't hear me talk about this today. We've got the FOMC minutes that we were all waiting for. And once they hit, my concern was the market would get a little upset because the market has priced in 4 rate cuts for next year. And the Fed has continued to say that we're going to get one, maybe two. So there's a disagreement between what the market thinks we're going to get and what the Fed keeps saying we're going to get. If they want to square this round peg, then something's got to change, right? Looking at what we got out of the market today, I'd say the market still doesn't believe the Fed. That seems to be the long and the short of it. The market says the Fed is lying. That's a pretty bold statement. What kind of themes are you guys thinking about for next year? Last November and December, we were all focused on gold and copper and China. And of course, AI has been a big deal, and copper worked out really good this year. Gold was great. China, not as great as we had thought. The companies in China, if you're trading with brokers over there, like if you have IBKR, you've got access to those China stocks. You probably did really good. But if you were like the rest of us trying to use the Chinese ADRs like Baba, Baidu, those, the US aid, they you didn't do too good probably, right? Not from a buy and hold play. If you were nimble, I guess, it wasn't that bad, but I was kind of disappointed myself, the way it all turned out. Could have been better. I like UFOs next year. And while AI took a lot of the oxygen out of the room this year, I'm thinking that next year it's going to be quantum. We all think we've seen the quantum run, right? Like we've seen some quantum playing out. I don't think we've seen anything yet, bro. Not even not even close. And so those two plays are they're very diverse, and, and it's a bunch of small company, low float, really thin, not really good options, but those two spaces are going to take most of my attention. And it's possible we could see at least one quarter of the electric vehicle takeoff and landing. EVTOL, EV, not EL, EVTOL, electric vehicle takeoff and landing. It's those air drones, right? Or those air taxis? That's what I meant to say, air taxis. Now I've done some research on electric vehicles before, these air taxis, and JOBY was a big favorite of mine. I've got a whole list of this stuff. I could probably dig out and dust off. I've posted it in the chat before, but shoot, that was so long ago. We'd have to really hunt it down. I did. Yeah, we're definitely going to get to that. I like Rocket. A Rocket ties in with yields. So anytime you're looking at Rocket, you want to have a firm grasp of what you think yields are going to do. I was digging back through my list looking for the electric vehicle post that I know I did. I know I've got one. I just got to dig it up here a little bit. There it is. Now, Amazon, Boeing, Google, Lockheed Martin, Nvidia, Qualcomm, Raytheon, they all have drone programs. And that gets to be a bit much, right? Because those big name companies, they're in quantum, they're in drones, they're in AI, they're in everything. You know what I mean? Like they're just too big, they're too diverse, too complicated. But there's a lot of other spaces for drones. And when you start getting into drones, there's different kinds. Some are defense, military, some are data collection. Some drone companies just sell components and parts. So when you come across any drone names, really try to make sure you understand what that drone company is doing. Because, don't be a blanket statement like, well, it's just drones. It's all drones. It's the same thing. No, it's not. And we're going to have that problem with quantum as well, because there's different kinds of quantum players using different techniques, different hardware, different approaches. It's not a simple system. Security, to me, next year is a really big deal. And I think that's why we're going to tie back into quantum. I can't see anything else next year being bigger that one issue. The whole idea, I've seen some posts about, you know, cooling off the quantum stuff by running that in space with or AI in space. That just doesn't make any sense. Eh, Why? No, no. You come across anything like that, really just kind of think it through. So in the Discord was a post to check out Rocket and possibly Intel. Well, that didn't go where it was supposed to. How about typing it into Thinkorswim? So one thing I like to stress when it comes to trading is that the candle chart doesn't have all of the answers. If we're trying to figure out if there's a play here, we want to look at as much information as we can get because the candles are only going to tell us what has already happened. And there's no depth or bias, context, or insight into what could possibly happen next. So you could only rely on the candles, and that'll get you so far. Sure, your success rate will be okay, right? And if you're managing your risk well, it'll probably get you by. But as you grow as a trader, try to bring in more and more tools to add to the system that you use. And unfortunately, it's not like some pre-packaged toolbox that we can just get off the shelf for all traders to use equally, right? It won't work that way. So what I like to do is when I come across something that I want to trade, I want to figure out what does it belong to? In what space should I be looking? Right? And that helps me dial in where I should be looking. I want to know who its peers are, how the space has been behaving. Is it hot or not? Is it tied up into anything that's being legislated through Congress, like a lot of the medical stocks right now, or pot stocks, right? That's a whole ball of wax and a can of worms and a room full of cats, or however you want to say it. It's a big mess, right? I don't want anything to do with those pot stock problems right now. And so, no matter what it is that you're looking at potentially trading, you want as much information as you can get. I've always had this firm belief that I don't know it all. And that's helped me out a lot. And I'm not saying that anybody here says they know it all either. I'm saying I've always approached the market with this idea that I don't have all the answers. And likely somebody else has done a lot of work that I might be able to piggyback off of. So I like to read things that analysts have to say, not the generic headlines that says, Susquehanna gave them a buy rating. So what, right? Like, shut up, Susquehanna. Nobody cares, anyways. But there's some really good detailed analysis reports out there that talk about these earnings or what their um, forward outlook is over the next 2 months after an M&A deal, right? Like, there's just so many things. So when you're looking at a company and you're trying to figure out if you want to take a trade here, stay in the trade, cut your losses, anything you're trying to figure out, just remember that the chart itself doesn't have all the answers. We want to try to get more answers. That could be starting with just the news. So on Thinkorswim, I can go back to basically Halloween, right? And I can start to scroll through here and look if I see any headlines that mention a short squeeze, merger, acquisition, buyout, CEO getting arrested, anything that could really stand out as a problem, right? Good or bad. Uh, um, if this was retail, we would be looking at, how did they do for their Black Friday event? What's their projections for Christmas? We're really just kind of scrolling along, looking to see if anything stands out, good or bad, that we possibly need to be aware of. And if there's upgrades or downgrades and they have something to actually contribute, that'd be worth reading. This is worthless. Right? Chad initiates coverage on Rocket with an outperform rating. Well, thanks, Chad, but you didn't tell us why. So go eat a pineapple, right? Like, what else you got? We can see it's a talk about a lot of housing and affordability. Now, I already know that Rocket connects to what's going on in the bond and the yield space. But if we didn't, that would be part of what we would start to glean as a heads up that maybe we should check to see what's going on in the dollar and the yields. Housing is at least 20-year, right? Or 30, 50. So we don't want to look at the short end of the curve, the 2-year, the 5-year. Want to go out past the 10-year at least and start getting into those 20s and 30s and see if we were to go look at the 30-year, would we see any headlines that give us clues as to what's going on in the housing space or the mortgage space or mortgage lending space? Any headlines that tie into, is this space growing? Is it shrinking? Are lenders tying up and not willing to lend capital? Like this headline here, the housing market has 37% more sellers than buyers, more than double last year's gap. So where's all the enthusiastic buyers? Not here. So don't get me wrong, we don't want to ignore price, but we do have to recognize that we might find answers outside of price. On Thinkorswim, we have up at the top this fundamentals tab. And inside of it, we can make sure that the chart is the same. And we have all of these different companies: Schwab Equity Ratings, LSEG, Morningstar, and these are free. I mean, you can buy some of these as well, but you don't have to. Um, but I will remind that these can be outdated. Like the Argus, that's from November. That's completely worthless. And sometimes you'll find them just grayed out and you can't click on anything. But um, use CFRA as my go-to. These guys typically have a section for like what I like and then what I don't like. And the what I don't like is something that usually gets my attention, right? So if they have a section that says I like this company, but well, tell me the but part. What do you not like about this company? Because maybe it's going to be something that I don't like about this company, and maybe I won't trade it. So you got to kind of scroll down to get to it. Maybe I missed it. Maybe I scrolled too fast. Should have been right in here. They usually will give you the peer group, and they'll say this is what we like and why we think it can reach the projected earnings targets, and then this is what we don't like and why we think it could potentially not reach those earnings targets. The earnings targets, by the way, are going to be right up here. You'll see that we start getting into where are they at? Start getting into the next year's targets. So CFRA, there is this one. Market Edge. Now, some of these, they're going to want you to buy something to go to get like the more advanced stuff, but you don't have to buy anything. And I would just keep repeating that. Don't buy anything. You don't need it. Take what they have to offer for free and just use that, right? Just stop there. Make sure this isn't an old report. It's from the 26th. That's not bad. Nice little write up here. Mortgage rates, lower mortgage rates drive a limited recovery in origination volume and revenue. Decent third quarter results. Origination volume is still low industry wide. They maintain $16 per share value. They got a narrow moat. And that means that their peers can challenge them, right? If there's a wide moat, then they're pretty much safe in their space and nobody else can do what they do. But a narrow moat suggests you got to watch their peers because they're in a competitive space and somebody else could take their market share. Wells Fargo, SoFi, personally, I think SoFi is a bigger risk to market than Wells Fargo is, right? Like that's how I see it. All right, and here's the bear argument. And I like this sort of work, right? because this isn't telling you to buy something or not buy something. Instead, it's saying, look, this is what we see, and then we can do our own due diligence from that, right? I don't know. Me personally, I like that more than somebody trying to spoon feed me and sweet talk me into buying something. They make a pretty good argument for why they are doing as well as they are. Okay, so after reading all this, I don't see anything that stands out or red flag of risk. I know it seemed like a lot of work just to get to that point, but I still remember getting my butt handed to me because of Target when it did its January post of its Christmas sales, right? So it's worth the effort to do what we just did. If there was any red flags, then hopefully we would have run across them and we could, address those accordingly. So then we want to ask, well, what's the short interest look like? There's a lot of places you can go to get this, and if you pay for it, you could get, better or worse answers. But generally, when I want to know the short interest of a company, I just type it into Google. It's free, it doesn't cost me anything, and it usually has a time frame on it that it'll tell you, how old the data is, especially if I click on it and I follow it over and I read the report. But for the most part, we're just trying to see, is it increasing or decreasing, and or is it at a really high level? Right? If it's at a really high or a really low level, then it can give us some heads up or a warning. So the short interest is running at about 30. And if you come down here, a short interest above 30 indicates a high level of pessimism among investors. The significant increase in short interest could suggest that some investors are closing their short positions, possibly in a response to changing market conditions or improved sentiment among the company's prospects. So, sure, it's heavy, but it's a decrease from the previous month. So, it was a lot worse and it's getting better, right? And this is a really quick little thing that you can do to get that answer on a stock, right? You see how I did it? I just typed in short interest and the name of the company. You could go to Investors Business Daily, Seeking Alpha. There's a lot of places that will charge you to get this sort of information, and maybe it will be a little more current depending on, if you're looking at some no name Joe Schmo lawn mowing company that nobody's ever heard of. It might be hard to find the information, but my go to is to do just like I did right here, where I just go to Google and type out short interest and the name of the company, and I see what's up with their short interest. We're only really looking for red flags, right? So it's not about some line in the sand. That's right, Finviz too. Yeah, there's a lot of places that you can get it, but I just want a nice little summary. And what we're looking at is from October. So this is not exactly, you know, right now relevant. We could probably find something a little more updated. Now, I am a big fan of using either Gemini or Grok. because now we've got some other questions to ask. You want to start asking questions about pump and dumps, or a lot of stock splits, a lot of dilution announcements. And while I didn't ask this question yet, you can ask, do they have any dilutions filed? Because what a company can do is they can file the paperwork and put it on hold. And then, since the paperwork's already filed, all they have to do is give the announcement, and boom, they've got it. Just because they file for it doesn't mean that they ever have to announce it. They can just let the filed request expire. But if they have filed for it, then you know that there is a threat of dilution that could happen at any time. It's a public website. What it's going to do when I get to that point and I ask it that question is it's going to go to the government website and it's going to search through the forms to see if Rocket has filed that form. You don't have to do it this way. You could just, go to the government website and do it yourself. But I'm lazy and I'm in a hurry. So I usually just ask AI to do it for me. So it's answering my question about pumping and dumping. This completely missed who we wanted it to look at. So we're going to grab the name of it here. Doesn't really matter where. I just need a place to copy. Come on. You know me. Yes, I'm human. This is looking at some kind of meme coin, so it went in the wrong direction. Now you can see how I asked it, did this company file for dilution? That's all it takes. You don't have to get, complicated and in depth. It's going to take a look and see if there was anything filed. And if it has something filed, it'll let you know. We're going to let it answer its own, get it done here, and then we'll do it. So the idea, right? We already know we got the chart. We can circle back to that and we can analyze it with our tools and, bring in more tools. So we're going to get to that point. But this sort of background has saved me so many times from getting my butt handed to me. Cuz look, I don't need someone to talk me into buying it, right? I already want to buy it. I need someone to talk me out of it. And that's kind of what I'm looking for. Any information that says you should just walk the hell away from this and leave it alone. Great, thank you. You know what I mean? I'll take the recommendation. So let's see. We've got a form. The last one was in October. That's a small one. This was for employees, general corporate purposes, employees again. And they had that merger and acquisition of the Mr. Cooper group. All right, it looks good. Nothing there. So now we can get a check when the last time they filed for dilution, which it basically already answered that. But if it hadn't, then that would be there. We'll pick it up. So what we found, we didn't see any red flag on the recommendations on any analyst stuff. We didn't see any pump and dump shenanigans. They're not big on diluting like crazy. And that just kind of a lot of red flags, right? Oh, of course, they put something behind a wall, huh? I like it. Things look pretty good. I don't see a lot of red flags standing out. And while you're on the FinBiz website, they have a news aggregate site. You want to go over to the aggregate part and just sort of scroll down and make sure no headlines really stand out. We know you're not going to find it on here, but like oh, failure to meet qualifications to stay on the index, or CEO arrested embezzlement, any sort of big hit piece short report. That used to be from a company called Heisenberg, but they're gone. And now we don't really have a standout report hitter necessarily. I mean, there's been some people trying to take up the mantle, but we don't really have a group like Heisenberg anymore. But still, if there was any major short reports, they would have popped up. We'd have seen them in the headlines. It's a necessary step, and it doesn't take long. It's not like you got to rush it because it's a swing trade, right? We got time. All right. Now, here's the seasonality for Rocket. Well, when it said more seasonality, I expected more on Rocket. Didn't need that. So January and February have a seasonality of really kind of just going sideways and not doing much. Good push in March, typically, and then giving it back in April, reclaiming it through May into June and stronger into July before it kind of stalls out again. So looking at this, put credit spreads wouldn't be that bad of an idea if we're really not looking for it to fall down that much. but I don't know that I'd really look for long calls because it's not showing a history of running in January and February. Instead, it's showing a history of kind of holding the line and not going anywhere. The 30-year fixed mortgage rates are around 6 or 6.2%, which is down from the peak. It was around 7% earlier in the year. And that's a favorable environment compared to what it's been in the last few years. Forecasts suggest modest declines into 2026 for those high interest rates, right? Getting down into like 5.9. And that could help rocket as well. So that's good news, right? I like that. I like that rise. If they hit these projections, they're going to be looking to do pretty good going from 6.5 to 10.5. Well, yeah. Of course, these are estimates and you can paint a pretty picture and that will work for a little bit, but at some point, the check comes due and if they don't satisfy, then people are going to pound this thing into the dirt. So yeah, most companies are smart enough not to paint some pie in the sky rosy number because they know it's just going to hurt them on the next earnings if they don't deliver. And the director seems to be cutting quite a bit of his position. Most likely, this is because they're looking to swap him out. I don't know that, but I mean, like, just he's getting out of a lot of his shares, and it's only him, so it kind of stands out that he's probably going to be replaced. Maybe he's going to retire, step down, something, right? I like it. I don't see any red flags. But if you go through these steps when you're looking to take a swing trade on something, it'll it won't solve all the gotchas out there, but it'll help keep you out of the what I call forced errors, right? The next thing is where's the next earnings? It's out there at the end of February. So plenty of room. If we did want to trade this and not worry about that earnings, then we want to make sure that we don't get any of the options around 10 days in front or 10 days behind that earnings. It's not a big deal, right? It's about 20 days. You just leave those earnings alone. Those options, I mean. So this was February 28. We're talking about like February 18 to March 16, something like that. Not a big deal. So the March options should be good if you're using the monthlies. Kind of come in here and take a peek. Yeah, March 20. Perfect. So we know that the March 20 options are outside of that earnings window. And we know that the February options are going to be right in that earnings window if you're using the monthlies. So these will probably have more liquidity, but then you also have the effects of the earnings on them. And for me, yeah, I'm just better off not messing with those. So we don't have to, you know, leave it alone just because of an earnings announcement. we can just look past that earnings. And of course, it's options. So you can get out at any time. You don't have to hold it into earnings or through earnings. You can get out whenever you want. The the company is a cheaper company, $20 company, and we got $1 wide strikes 80 days out. That's not bad. That's not bad at all. If we were up in the front, I would expect something like 50-cent wide strikes, and that's what we have. But farther out like this, $1 wide, it's fine, no problem. If you got in there and they wanted $2.50 wide strikes on a $20 stock, just walk away. It's not even remotely viable for anything that we want to do with that strike width because that's a signal of liquidity issues. So we got liquidity. We've got a lot of open interest on the call side. We can see triple digit or double digits, right? It's 20,000, 22, 30,000. And on the put side, we've got just over 1,000 on a lot of these strikes. I got to say, I don't like that. This implies that they're selling calls right over your head between 20 and 27. You got this ceiling of short calls right there that's going to stop you from getting a run. Now, not a run doesn't mean fall, right? And that leads back to the put spread that we were talking about. Selling a put credit spread is fine because we don't need it to run. We just don't want it to fall. That's two completely different things. These will act like gravity, right? So you're in the earnings window with your 20 February. If you got these options, then you're dealing with the earnings event. It's got elevated premiums because of the earnings, and they're fake. They're not real premiums. You got the higher implied volatility. If you bought them, you had to pay more for them. If you sold them, then you quote got more premium, but it's not real. They won't monetize correctly. You're very likely going to be stuck in them, whether it performs well or not, until you get really close to that earnings before they finally kick in and lose their juice so that you can make your profit. Seen that happen too many times. So what do you got? A vertical? Did you buy some calls or sell some puts or what'd you do? I'm betting you bought some calls because I see the puts. Nobody's trading those puts. Yep, one contract, straight calls. All right, so you paid up a little bit. You bought a call in the earnings window, and because of the higher implied volatility, you paid a bit extra for it. They're going to manipulate the implied volatility on these because that's going to be the static for the window of how far it can move. And they want that window to stay still as we get into earnings. So you won't get any benefit from, say, a volatility crush and or a volatility flush, I should say, a pump up in volatility. You won't get it, even though we're going to see volatility rise as we get closer and closer to earnings. You can see after the earnings how the volatility was high and it decreased. Well, here in a little bit, it's going to go back up again for the next earnings, right? And then it's going to be up here and it will report and then it'll drop back down again. That rising implied volatility should make your call swell up with profit, right? Because increased volatility makes the contract worth more money, and that's a good thing, right? We'll take that. The problem is because it's an earnings implied volatility, you won't actually feel it, see it, monetize it. You're just not going to get any of it. Also, see the difference with this earnings. We had a little bit of volatility decay, and that was all. And then as the stock went up, volatility went up with it. That's really odd. That's not the way things generally go. So there's something about that that makes me getting a little nervous. Let's see what's we're not done with rocket. I just want to see what's up with gold. Oh yeah, you feel it. You feel it. It's not that bad yet, but yeah. Good call, Bigfoot. So you see this situation with the implied volatility over here on rocket. This is showing that traders are getting a little nervous about either how far it has come, and here on the monthly you can see why they're getting nervous, right? You get a little ahead of your skis that way. So maybe they're nervous about how far it ran, or they're worried about, say, PAL and interest rates and FOMC and all of that. But either way, whatever they're worried about, when you look at the implied vol after this earnings back in July, we really didn't get a volatility crush. It went down a little bit and then it went up. Even as the market went up, it was going up. And that sell off didn't reduce the volatility at all. Then we got this earnings and we've had that vol crush and it's just continued to crush that volatility. My concern is that they're going to continue to bleed this volatility, and that's going to take profit away from your call, because with a naked call you're now exposed to whatever volatility does. If it goes up, if it goes down. If it goes up, that's good for you, take the money. If it goes down, it's going to suck the profit out of your call. That's half of the concern, but it's an earnings call, and that means you're kind of protected from that volatility crush, because we know that earnings implied volatility isn't real, and we never actually feel that effect in the option itself. So on the one hand, you're kind of at risk and exposed, but on the other, it might cancel itself out. If it was me, yes, I would have traded an option that was not in the earnings window. That's sort of the best way to just avoid the whole thing, right? Either getting in front of it or going out past it. And usually going farther out is the better choice. Usually. It's not to say that your trade is going to lose just because you got the earnings one, right? But now, on top of everything else that we always have to worry about, you now also have to worry about the earnings impact and the implied vol moves and all of that stuff. So if you can just take that risk off the table, then that'd be better, right? Just avoid it from the get go, and then you don't have to worry about it. I like the idea of just having a simple straight option and not a complicated spread. Nothing wrong with that at all. But even though, so here's why I say that. If these options were $20 a piece, I would have asked, why the hell did you buy a straight option, right? $20, $25, because that's expensive, right? $2,500 options, super crazy. I would be really concerned and wondering why you did that. But these are not that big, right? They're like a buck and a quarter. So a straight option is simple. The risk is defined. There's nothing wrong with it. So we can just do that and call it good. We don't even need to make a spread. But the reason that you might want to do a spread anyways is because of the protection that it provides. See, when you buy a call or when you buy an option, you've got that theta decay, right? And it doesn't sound like much. It's just theta. Everybody knows it's there. So what? But it's a little more than that. So in the February, you've got 1 penny a day. No problem, right? It's just 1 penny. Every day the option is going to lose $1 from theta decay. Big deal. Well, if you hang on to it until, say, January earnings, or not earnings, but January's monthly, now you're paying a much higher theta value per day, 25, 28 for at the money. So in between those two dates, in less than 30 days, you really start to pay some theta. But when you buy one option and you sell another option, you cancel them out. So you're buying one theta, but you're selling another theta. That means you no longer have theta risk. There's always a tiny little bit, right? Especially when you get really close to expiration. You can see how the theta in here, well, now it dropped down. Where is it? This one. Two, where'd it go? 3, 5. All right, here's the differential. So when you hold it way up against the expiration, you'll finally start to get a little differential, and now you're paying theta decay. But until then, you bought one, you sold one. Not just the option, but the theta. And so that can help cancel out your theta bleed. It can also do the same thing for the delta, for the gamma, for all the Greeks, right? Volatility, we was talking about how volatility can affect your earnings trade. Well, if you buy that 20 and you sell, say, the 22, then you bought a 3 and you sold a 3 in volatility. You a theta and you sold a theta. They cancel each other out, and that protects you from volatility shenanigans and theta decay. Looking at the cost of this spread and recognizing how much you paid for your call, just a straight call, versus how much you would have to pay to get this, I understand why you bought the call, because I think for this price, I'd rather just buy the call too. But if you can add a tail for any price, right? There's your $20 strike. If you could add anything at all, just to get something on the other side of it, put a tail on that dog, right? We can't go past 26. So if we sold that one, we still get some form of protection, right? We're not losing all of it on the volatility, but we are canceling out that theta for now. As we get closer to expiration, the theta is going to catch up with you, but it protect you for a while, you know. Now this is a $6 wide spread, and we got it for $1.38. Let's just call it $1.50. $6 wide spread, you got $1.50 in credit, or in profit potential. So it's not capped that badly, and you get some theta protection out of the deal. It's better than nothing. You don't need it though, right? It's just a way to, what I use the word shunt. It's just a good way to shunt the impact of Vega and Theta so that your option isn't bleeding out as you get closer to expiration, simply because time is catching up with you. And on an earnings option, the volatility is sort of the issue too. So that would cancel that out. But you know what's cool is you can add that short leg whenever you want. You might be sitting there saying, well, shoot, I wish I'd have known that when I got this trade. I could have got the short leg then. Yeah, but you can still get the short leg now whenever you want, right? You can do it at any time. The other reason why it's good that you got a naked call is, what if you don't want the short leg now? What if you want to sell that short leg with this week's expiration in mind? Why not, right? If you really think that we're not going to go anywhere, say, do you think we're going to get above 2050 by the end of the week? I don't think we are, right? And if you don't think that we can get above 2050 by the end of the week, well, you could just come in here and you could sell that call right there. It's not going to give you very much money, but It's money that you didn't have. And if you do that again next week, and then you do it again next week, you could eventually pay off that long call before we even get to the long call. And then you don't even have any risk anymore. So, say you did sell this, split the mid, you got $16 for it after commissions. Let's say you end up netting $8 profit when you finally close out the trade. In my books, when I do that, I go back to my call and I stack that $8 from the price of the call that I bought. So if you bought that call for, what are these things running at? If you bought that call for like $1.58 and you sell this one and make an $8 gain, subtract that $8 off of the debit you paid, and now you're holding that call for $1.50 instead of $1.58. And if you sell that call again and you make another 10 cents, come back and subtract that 10 cents, and now you're holding that call for $1.40 rather than $1.50. And you just keep doing that until you pay it off. If the opportunity presents itself, right? Because you don't want to do that if it's looking bullish, like it could break a level and run you over. And what is your risk if you get run over? Really? You know what I mean? Like, is it really that bad? No, because you got the loan call. If you wanted to add a short leg on the same expiration as your long call, you've got that long 20, right? What you would do is in the same expiration, just go in and choose one to sell. A couple of things though, if you've got this 20, then you need to sell things that are farther out. One, because that will give you a debit spread and not a credit spread, which is really important, right? You don't want a call credit spread. But two, margin costs. If you was to sell a call on this side, then you're going to have to pony up, right? But on this side, you're fine. Everything is dependent upon the long call that you've got, the $20 right there. So it shouldn't require any margin restrictions or reduction margin spending, anything like that. You just go in and pick the call that you want to sell and work the order. There's a $3 gap here, $4 gap here, $5 gap here. If you're going to go in and pick one of these options to sell, haggle, negotiate, right? Just like going to the flea markets or a garage sale. Don't pay whatever they're asking. And in this case, don't take payment with whatever they're offering. Try to get a good deal. If it doesn't feel right away, then you can always adjust, but at least try. If it says 53, try to sell it for 55. Who knows? Maybe you feel. If you do, great. If not, then, after say 10 minutes or so, you can take a penny off, see if you feel at 54. I like to work the order. And if you've got, say, a 10 lot, you got 10 of these calls that you need to cover, don't load all 10 at once. Sell one, see what price it eventually fills at, and then sell another one. The reason for is if it's not really liquid and these aren't changing much, I go in and try to sell one at 53 and it instantly fills. Well, I know that I could have gotten a better price. But if you did it with all 10 of them right then and there, that you missed a chance to make a lot more money. That I've done that without working the order, and I've missed an opportunity to get an extra $8 to $12 per contract on a 20 to 30 lot trade. That adds up real fast. Now, if you're just one lot, it's not an issue. Work the order, get what you can get, call it good. But you can always add that short leg whenever you want. And you're not stuck with it either. You can take it off. So, say you hold it over the weekend and you hold it into the new year, and we fade down to $19, and that short leg monetizes pretty good. You're happy with what you got, and you close it out. And then it runs on the back half of January, and we run up and we break 20 and we really start getting after it. Well, that'd be awesome. You made some money on the short leg, closed the short leg, and you still have your long, and we end up running out on the other side. So you can get out of it. Just watch, pay particular attention to the cost of that short leg when you get it. How much did you sell it for? And if I sold it for 53, I'm going to try to get, a good third of that back. That'll be my first exit target, would be one third of that. Because I don't want to hold it all the way to expiration, not if I still want that long call to be a long call. Now, if you don't mind carrying the whole thing as a debit spread, then sure, just keep it, call it good, no problem. Here's the fun stuff. I think we've all had this happen. And if you haven't had it happen yet, well, it will. So, just be patient. I love it when you get one of those situations where you think you might be able to make a move back to the top. So you buy a call down here, and 2 days later, you're all the way up here, and you're like, well, that was not what I expected. If I knew it was going to do that, I'd have bought 50 of them. But it happened, and you've got, this trade that isn't going to expire until all the way over here. If you have that sort of situation happen to you, what you can do is at this point sell that short leg. No reason to get out of the trade because it might leg up again even higher. What do we know, right? It might. So if you get into something and it just runs, it's just a ripper right away, and you're like, well, shoot, I should take profit. Maybe. If you bought the call for $1 and then it makes this crazy move and you can sell a call up here for like $1.50, you've got a risk-free trade now of 50 cents. That trade cannot lose, and you're guaranteed a bare minimum of 50 cents because you sold a call that was worth more than the call you bought. Just keep them in the same expiration and make sure that the call that you bought is farther out of the money than the call, or the call you sell is farther out of the money than that's it. That's a risk-free trade. I do that in the SPX because that thing as a day trade, it's a mover. It scare the heck out of you. So I do like Rocket. I think it's got potential. The concern, of course, is the technical analysis. We've got this range here. We're inside of a box. And then we've got this range here. And we're inside of a box. Now, technically speaking, there's still one more box, but we don't need to mark it because this is the immediate one. And on the upside, it's the only one. Once we get through this, we've got that, and that's it. With this one, we're already above the half. That was the danger spot, right? Getting through this midpoint. And now that we're through it, that's it. You're already on the other side of risk. If we was down here, I'd be a lot more concerned about your trade. But we're not, right? We're up here, so it's great. But now, depending on what you had, we got to get through that line in the sand. If you have a put credit spread or, a short put vertical, then all we'd have to do is stay above those puts you sold and we'd be gold because we'd have that support and we'd have that support. And that's two things of protection. For your long call, now we got to worry about the resistance. When I look back and I see this, come on, drawing tool. There you go. I see all these wicks. I get a little nervous, right? because we ran up and got hit and ran right back down again. We don't know if we've gotten all of that liquidity off the table yet. And for all we know, the next time we go up there, there's still just a lot of sellers sitting up here waiting to get out. Now, if you had a 10 lot or a 20 lot, I would say, get some profits as we come into that in case we don't make it through. But if you've only got one, you don't really get much of a say in the matter. When we do finally get above this level, this thing can go to $40 in the next year and a half. In the next year, really. There's an old phrase that says if 20 then 40. And I know it's glib and it sounds too good to be true, but it is true. Look at how many stocks do it. It happens all the time. If 20, then 40. But it's not just, well, I hit 20, so now I'm supposed to go to 40. It's got to get above 20 and prove that it can keep it. And you can see it got there, it wasn't able to keep it, and it sold off, and it did it again, and it sold off. When it finally does get 20 and keep it, well, then we're going to be looking for 40. And it'd take probably a year or so, but it will get there. And the phrase, if 10, then 20, right? If 2, then 6, or if 2, then 8. But if 8, then 10, and if 10, then 20, and 20, then 40. And of course, there's a 80-100 too. If 80, then 100. So many stocks do that, right? So we're looking for this company to double its share price from $20 a share to $40 a share, very likely in the next year, maybe a year and a half. Yeah. Yeah, I'm going to show that picture in the stream. That's a nice picture. Right? So that's the concern, is that we're going to get up into that level and there's likely going to still be some sellers there. The faster the better, right? The longer we sit in them calls, the more the bleed. But I mean that's not exactly 100% accurate. Let's talk about that for a second. Everybody thinks that you bleed theta if you bought a call. And in theory, that's right. But I can prove that if you bought a call, you will actually make money just sitting in it. Of course, it would help if we had a vertical. We don't have a vertical, so I guess this demonstration won't work. If you add that short leg, then it'll work. Let's add a short leg so I can show this. So we got a 20-25 here. 20 long, 25 short. We'll throw that into the analyzer. We'll turn that single off. So suppose this is our trade. If you're in a call or a put vertical, long vertical, not a short vertical, and you're on the right side of the break even, every day that you sit in the trade, you're going to make money. You will collect theta as if you sold a call credit spread. But you didn't. You bought a call debit spread. This yellow line is a representation of how much the trade is worth, right? So when I move my mouse here, we can watch this the area down here as I move my mouse. And I just stop there. That trade is worth $211 at this point. Every day that goes by, and this is December 30, we can see the date, December 30. But every day that goes by, watch that yellow line. It's going up. So now here's January 20th, and we can see that we made money. All we would have to do is sit there. Price didn't move, volatility didn't move. All we did is change time, and the cost of the option trade increased. So if you're in a vertical and you're above the leg, above the break even, you can just sit there and collect profit, just like if you had sold to open a call credit spread, which is really cool. Collecting that theta isn't just for the premium traders. And that's an argument to actually stay in a trade rather than hurrying up and taking profit. If you're in a long call, just a single long call, take your profit, right? Take your profit, get out. But if you're in the spread and it's winning, you might as well stay in and try to get more money. And that's why it really matters that we know that in advance, right? So that we don't always do one thing, like always take profit as soon as possible. No, not necessarily. So the work we did looking at interest rates and all of that probably won't be helpful just a 2 month trade. But if you were looking at, you know, 9 months, next year, kind of a real longer term trade, that sort of work would be really helpful. And you would still want to ask, did they file for dilution? Do they have a dilution history? Has any of its peers recently filed for dilution? Because if you guys remember when the drones like Joby and those others, when they started filing for dilution, it's like they all did it. All it took was for one of them to do it, and then they all started doing it. And so if you find a peer group where they're starting to dilute, then I mean it's a good heads up, right? Like, well, I don't want to buy that sucker. They're gonna announce some kind of share reduction or a share flush, and the stock's gonna drop from it, and then it's gonna beat my call up. That thing is in a big old range. But when it finally comes out of that range, I think it could be one heck of a run. If 20, then 40. Meta for 2026, I'm not a big fan of Facebook. I really, really not a big fan of Facebook. But these guys spent so much money and they hired the brightest minds in that space. And you can bet they're going to be trying to figure out ways to monetize that, right? Advertising, ad revenue, product development. Now, investors are going to punish them if they don't have something to show for all that money they spent. So it's not like this is a risk free trade. They better have something to talk about at earnings to justify all that money that they spent. But Meta is now one of my long term trades. Long term, not like the next 3 months, but like the next 3 to 5 years, because they changed the game in that space. Who knows what they're going to do with it? You know what I mean? Like, I don't, I bet they don't even know what they're going to do with it yet. But you don't bring in that much talent and get something out of it. The big risk, however, is all the money they spent. Investors might throw a fit and puke this stock at earnings if they don't have a justified answer for it. I've got buy orders at 600 550 and 500. I don't know what I'm going to do if it gets underneath 500. Probably start cutting it a little bit at a time. All right, now one was Intel, right? Let's go back and look at that. Intel right there. Now, Intel has a sugar daddy. Must be nice to have a sugar daddy. So the government has stake in Intel. How much of a stake? Well, we'll find out here in a second. Um, I believe a number of companies bought stake into Intel. Yeah, $8.9 billion investment purchasing approximately 433 million shares at $20.47. They did that back in August. That's a 9.9% equity stake. Usually the headlines they just say 10%. Now it might be TSM or Nvidia, um, SoFi. It wasn't TSM. Nvidia. Nvidia announced in September, and they just completed the deal in December 26th, which is going to be filed for December 29. That was yesterday. They purchased 214 or 217 million shares, $5 billion worth at 23 and a quarter per share. So Nvidia's got about a 4.5%, 5% stake in Intel. And then SoFi came in with 2 billion. Apollo brought in 11 billion. That's a lot of sugar daddy, right? So it's not to say that it can't go down. We know it can go down, but the money invested in this over a 2 or 3 year, 5 year plan probably has some forward outlook. It's going to be pretty amazing. Nvidia had an ask connected to it, right? They wanted some adjustments, broader collaboration on AI infrastructure, custom CPUs with NVLink, and personal computing products. So if they start pumping out custom AI devices and things like that and pick up some government contracts, that's when I heard government getting into this. That's the first thing I thought of is, oh man, wait till Intel starts pumping out government contracts to make very specific devices for the government. Even just phones, you hear about it all the time. If you travel to another country, don't take your phone, buy a burner, use some generic turd that doesn't have any of your personal data in it. So if they start making, say, PDAs, phones, tablets, laptops that are government secure, and they're getting government contracts, that could turn a corner, a big quarter for Intel. It hasn't turned into anything yet, but that's the level we got to get through, right? So if 20, then 40, we did that. That's already done for Intel. Now we got to get above 40 and keep it. If 40, then 80. And we didn't get there last time, right? We got above 40, made a good run at it, stalled out, never got to 80. So it still owes us 80 from the last time. And we're back above IPO, which is good. Or at least we're back above the farthest distance that I looked back. That's not IPO. Let's look at it, Max. There we go. Yeah, that's what I thought. So they made it to 80 last time. Dirty dogs. Look at that. 80. Well, oh, they missed it by a couple pennies. Of course, they probably had a stock split since then, and who knows what their price was. So I like Intel on the long road, but that's another big picture trade. If you're just looking at a short-term trade, then first thing we got to ask is where the hell is that earnings? 28th, same thing. Rocket Mortgage, same time, right? Right in that same window, 10 days away from Rocket. At least with this one, if you had February 20, you're just you're just inside that window, and you could possibly miss the earnings. Possibly. These are a little more pricey because they got more volatility in them. Looks like it's going to gravitate towards the 40 strike. We got 27,000 contracts traded today on the 40 strike. The problem is we don't know if they're closing some of these out or if they're adding to it. So we can investigate that. Scroll down here to the time and sales, and we want the 40 strike call for the February 20. And just put a just a bare minimum number in there just to weed out all those one lotters. Makes it easier to spot. There was a lot of contracts traded today, right? 27,000 contracts traded. So it shouldn't be hard to find. There's some of it. Now we got to put the date on there. Well, they bought 3,000 more. You can see these are a spread. We can get rid of that spread. Just click condition. It should get rid of most of those. There we go. Now we're cleaning it up. And most of the selling came in the afternoon. Well, no, it seems pretty mixed bag, huh? 3,000 and then another 1,000 I'm not seeing 27,000 in that. Let's see what else we got. 2 to 1 on the put call ratio. The sizzle index is running at 2.5, so we're above the 5-day average call volume by 150%. They're buying more calls than they're selling. And they're selling a lot of out of the money puts. I like that they're selling out of the money puts. That's a good thing. They sell puts to help finance their calls. And they would only do that if they're buying calls and not running like call verticals, right? Because the vertical kind of defines its own risk. You don't need to sell the put. But if they're just straight up buying calls, then sell the puts to help finance those calls. And the calls that they're buying are near the money, like that. Don't get me wrong, though. I mean, we do have some out of the money. Those would be like the lotto plays. So these are the call options for February 20. And we want to know, where is the greatest concentration of open interest at the 40 strike? And then at the 45 strike, and then the 35 strike. So that's the greatest concentration of options. 40,000, 50, 65, 70, about 80,000 contracts, all at or better than Intel's current price. I like that. So come back in here, right click on this, send that to whatever color you're using. I'm using red. So we're going to send it out here to red. This is those calls. Look at the volume. It's green, right? Those calls were bought today, not sold. So they bought an additional 20. Well, we don't know that they kept them. They could have bought them and then, closed out of them for all we know. There were 27,000 calls traded today on that 40 strike for February, and they were initiated as a buy order. Whether they kept them, we can't say. I'd want to see the open interest on Monday or tomorrow. If you guys are going to be here, look at the open interest tomorrow and see if it's better than 40,000. I think it was 40,000. Yeah, 40,000. So if they keep even half of them, the open interest tomorrow should be like 52, 54, something like that. The put volume, on the other hand, is a little lighter than I'd like to see, but it's likely that they're selling those puts in a different expiration than this one. I would. Did you guys catch that run in Neo? Man, that was such a good play. If you didn't get it, wait for it to reject off of the 6.25 level, that half. I'm expecting it to digest around this level. And then we want to get above it and show that we're going to keep it and then run that sucker back to 7.5. There are some gaps to close. So you can look at these levels to spot where the next pause is going to be. I really like Neo, but XPEV has a better chart. It's already above that 100 moving average. This one it's got a lot of moving averages overhead that it's going to have to fight to get through. But I mean, it's not a very big base, and it broke the base to the upside. It's just fantastic play. I'm going to adjust this and use the real low here instead of my adjusted low. That's 614. Let's run this all the way up to the top at 638. I like 6.5, but that's the real move. Okay, this gap is closed. They closed that one. So the next gap is right there, just above $6. But we got to get above this gap. We closed it, but we still got to get above it and prove that we can. Then we're going to run for this next gap. If we come back down below 5.5, I think we're going to just come right on back down here. That's not going to be good. Look at how it behaved on that gap fill today. Tweezer top flipped over, and that was that. Man, it just took it out. It's like it activated a cell program. Maybe we better lower that and say 5.25. If it comes down below 5.25, we're probably going to have some trouble. Here's 5.25. Stay outside of that box. So that's Neo. It's got a good start. I like this into March or April. And then here's XPEV. I know it's ugly. I mean, this is really, really ugly. But it's already above the moving average of trouble. So we got some gaps on this right there. That one's filled. There's your next gap that needs to be filled. And of course, we're leaving gaps on both of those, Neo and this one. We're leaving gaps behind. Those are going to need to be filled someday eventually. But as long as we still got the push, run it till it breaks. I don't have XPEV. Lulu turned around. Nice. Come on, give me, give me. But it's a lot more expensive. Oh yeah, I bet. I bet that was not fun. Was you able to hold on to it until it came back out? Oh yeah, it worked. Yeah, yeah. I feel you. When Google was thousands of dollars, I got trapped in that sucker, and it took oh 9 months to finally get out of it. And I got trapped in Netflix one year on an earnings play on a 0 day trade in Netflix that lasted almost a year. But you hold them long enough, you can work them around and finally get out of them. It took me a while, but I got there. I was bound determined not to lose it too. Just it wasn't even the at first it was the money because I had a lot of money at risk. But then I reduced the risk eventually, and I just kept at it anyways, just out of a matter of principle until I finally got it into green. But I didn't even make much money off of it. The main thing was I didn't lose a boatload like the risk was. Yeah, lessons learned. You don't learn those lessons out of the text. You just gotta put your hand in the fire and realize that yep, that hurt. Apple's doing its Apple thing, but it finally broke that trend line. So now it's got to prove itself. I'm just shopping around here. What could we get if we did think it was going to get a little weak? Where's its earnings? At the end of January. That's Apple's earnings right there. We can check to make sure, but I'm pretty comfortable with that. January 29. So the end of January, first week of February. Look at that. End of January, first week of February. That was earnings. Isn't that cool? Didn't even have to go to the chart. You can see it all in the options chain eventually. All right, so we don't want those, right? Let's look at the February 20 options. for Apple and some cheap puts. Where is cheap starting to show up at? 230, 225. So if we was to buy at 240, maybe sell at 225, 75 cents, our break even would be 239.30, 239.30. We don't need to remember it. We'll just have the machine put a line there for, throw it in the analyze tab. There it goes. It's like it was stuck on silly for a moment. We just ask it for the break even, and then we tell it to put that break even on the chart. Of course, we can't see it because of all my lines. It's way down here. So that's a way out of the money. Put debit spread, 75 cents. We would only get paid if the stock fell towards our area. But we've already taken the earnings volatility crush. And it's very likely if we were to fall, we would take a rise in volatility. That would help the cost of our put. And as we get closer to earnings, the volatility is expected to rise. But that volatility isn't real, right? That's fake. But if Apple falls, the expectation is that the implied vol would go up. And that didn't happen here. Apple fell and the IV fell with it. But that's what's supposed to happen, right? IV is low right now. And the old phrase with IV says if it's low, it has nowhere to go but up. Now we know that's not true. It can it can stay low and it can go lower, but that's generally the phrase they use in the market. If IV is high, then it has nowhere to go but down, and if IV is low, it has nowhere to go but up. If we buy some puts and IV rises, those puts are going to do a lot better. Of course, if you want to buy some calls and the IV goes up, well, then your calls are going to do better. I'm bullish Apple in the big picture, but in the short term, say between now and earnings, I think we could see a little bit more weakness into that 240. Thing is, there's no reason to short anything right now. And I only want to short it because it broke that trend line. That's the only reason I want to short it. But really, until it breaks this level, you don't have a confirmed short. And if you're going to take a gamble, you should have tried to short it against new highs. Like when it broke this level, getting short on that breakout, you'd have been wrong for 2 days, but it would have been a better play. Shorting it now when it hasn't broke the low and it isn't back at the top, this is like a wishy-washy 50% in the middle of nowhere trade. Sucks. That's why Neo was such a good trade, right? Neo was sitting down there, perfect, right along that low. It was beautiful. Apple sitting in the middle of nowhere, we got nothing. So maybe put it on watch. This high and this low is the issue. If we can break this high, we're going to try to challenge that high. And if we break this low, then we'll look for like a 111 or a 1236 and try to get a bear trap and then squeeze that thing like a TRB into March or April back up into 285, 290. You know what I mean? Like, I'm not looking for long-term downtrend in Apple, just a little bit into that next earnings and then a nice pop back out again. But we might not even get that. It could just turn around. All right, guys. Um, hey, it's the end of the year. If you are going to be trading in the last few days, please be careful. I'm going to wrap it up here. This was recorded. I always appreciate you guys showing up. You make it a lot more fun than me just sitting here talking to myself. As always, if you have topics that you want to cover or things that you want to look at, hit us up. We're all here to help. I know myself, I love the requests. I like knowing that we're covering something that will directly help somebody, and I always get a lot out of that. So I appreciate you guys. Be careful, be safe. I'll see y'all next week. Yeah, yeah. What's the Yeah, I mean, I haven't gotten the work. Yeah, I haven't gotten the work done that I wanted to get done before I really started making the announcement, but I am going to be pushing my YouTube next year. Um, I've had it for years and I never really did anything with it, but someone challenged me to start getting it out there. And I like it. We're going to do that. It's going to start with new traders and then work into advanced stuff. When I was hired at the Bullish Bears, they wanted only advanced from me. They had other people to do the intro and beginner, but I've always felt like that's a big hole that didn't get filled as well as I would have liked. So I'm going to start putting some pieces together and building it out on the YouTube. And of course, I'd appreciate it if you guys go over there and support the channel. It'll have my Thinkorswim workbook in it, and I'll build out a TradingView workbook. End up having to split those two apart. I really think TradingView next year is going to have a lot to offer that we've never seen before. So it's going to need its own workbook. And then, of course, the content will be going from there too. Yeah, yeah. Thanks for reminding me on that. There's really there's a lot of stuff that's there. It's outdated, but it's there. Of course, we'll be cleaning all that up, starting fresh, and putting them into organization with some distinct modules and categories. Been a lot of planning behind the scenes. Yeah, it's going to be the one that I've already got now. I won't be doing another one. What I've already got done, I'll be cleaning up and putting into modules, but then after that, it'll all just be fresh content. No, the process will probably be a whole new thing. Because this, what I do with you guys in here is like a Q&A, and we just go through whatever. On the YouTube, it's going to be more structured and class oriented with specific topics, working from a point A to point B, and then covering one topic at a time. 20-minute videos or less, very specific to one topic, and then on to the next one and the next one in a really class format sort of regime. Oh yeah, yeah. I'm still going to do the morning briefing. It's not going anywhere, and I'll still be doing these. I'm just going to start. Yeah, it's just going to. Yeah, yeah. Right. Yep. I'm just adding more content, and it won't be live. It's going to be me recording something and putting it on YouTube. You broke up. I'm not sure what you said there. Yeah. So everybody, enjoy your New Year's. We'll be back next week. Start it all over again. You, y- yep. Happy New Year, everybody.